Good evening, everyone, and welcome to the 13th edition of the WhiteOak Quarterly Connect. This is our first Connect in the new year, and let us start by wishing you all a very happy new year. Thank you for taking out the time to join us today. The timing for the Connect couldn't be better, considering that the interim budget was announced yesterday. The budget largely focused on continuity and is pro-growth. Today, Prashant Khemka will spend some time to discuss the key takeaways of the interim budget. He is joined by the senior investment members of WhiteOak, Rohit Choradia and Parag Jariwala. In this session, we will also cover the portfolio positioning of WhiteOak funds. I request you all to post your questions on the Q&A chat box and they'll be answered over the course of the session. I now hand over to Prashant to talk about the key takeaways of the budget. Over to you, Prashant.
Thank you, Sunanda. And thank you everyone for joining us today evening, Friday evening. I'm going to share, is this document visible? What says WhiteOak Group?
Yes, Prashant, it's visible.
Okay, great. So we've incorporated some of the feedback that many of you provided. One of the things, as you would have noticed, we started half an hour early, so it's at 4 p.m. Apologies, 3 minutes late, but idea is to start at 4 p.m. and relieve everyone that much sooner on a Friday evening. Before I get into the budget, there isn't. Before I get into WhiteOak specific matters, let me just quickly cover a few comments on budget. There are some slides, but there wasn't really much to cover. Yeah, it was the shortest of budget speeches, as it was a vote on account, less than an hour, typically lasts 1.5 hours to 2 hours. The key highlight was that fiscal deficit projected is 5.1%, in large part due to buoyancy of tax revenues, and there were no populist measures announced, as was some concern. Nowadays, people don't have any concern from this government, so I would not say it was a big concern on populist measures. But to the extent there was, that was, dispelled as well. The capital outlays were increased by double digits, about 11%, while 11% is not a whole lot when you think about the nominal GDP itself is growing at 10-12%, so in line with nominal GDP, but it comes on the back of a 30+%, 33% jump last year, and the year prior also was similar. So it's doubled in 3 years, or is up 50% in 2 years. So that's a positive for the continuing build out of the capital stock or the infrastructure stock of the economy. So no major negative. It's a vote on account. It's more like a trailer. The real budget would be in July. If we assume it would be the same government and same finance minister, then this could be considered as a precursor or trailer to the real budget or the real movie. And in that regards, it's a positive that directionally it is usually very tempting, would be very tempting, one would think, that in a budget just before the election, there would be some kind of populist measures there, like there were in 2019 budget, yeah, for those of you who remember. But in a way, it also shows the government's confidence in itself. Everyone seems to be confident. Investors and the market certainly are very confident about the election outcome. It seems the government also is quite confident of the election outcome, and they don't believe they needed the help of any populist measure from this budget. So that in itself is a positive as well. So I'll just stop there on budget. As I said, there isn't a whole lot. If there are any questions additionally, we'll address them later. So turning to, just an update on WhiteOak, obviously helped by the market, but also very robust inflows from foreign investors. The AUM outside this does not include the mutual fund AUM, which is about $1 billion plus now, but close to $6.9 billion in AUM outside of the mutual fund. The proportion of AUM coming from foreign investors at close to 70% has increased over the last 12 months or so. as we've seen some very robust flows from foreign investors. I think overall in the industry also inflows have been good, and particularly given the strong performance of the team, the inflows for our foreign funds have been stronger. When I say strong performance, yes, trailing 1 year, 2 year, 3 year performance has been more mediocre, particularly because of the very weak performance in 22. But foreign institutional investors typically look at a longer horizon over the cycle or longer, and that remains at the top of the peer group, and hence we've seen very robust inflows as foreign interest has picked up. About 50% of the total AUM is from ultimately people like yourselves, high net worth individuals, ultra high net worth, or family offices coming directly or through private banks and wealth managers. 37% is from institutions like sovereigns and pension plans and so on. I'm going to skip a lot of these slides, which you're very familiar with, just to pause and update on the team. We are a 45-member strong team, the most well-resourced team of seasoned investors in the industry. As most of you by now know, we don't only offer an India strategy, but also have an EM strategy, the only India, or at least the first, if not the only, I think possibly still the only, to have an in-house global emerging markets capability. And of the 45, 33 members are involved in India investing or research, whereas 25 are involved in non-India investing and research. Obviously, there is some overlap. About 12, a dozen of us or so look at both India and EM, depending on sectoral coverage and whatnot. Sectors such as IT services and healthcare services, which are more global in nature, the same sector team covers across board, which has certainly benefits in terms of idea generation and identifying trends that have played out or are playing out globally and might play out in India over time. In the interest of time, I'm going to skip, as most of you, if not all, would be familiar with the slides here, and move to first covering the performance numbers as they are, and then digging deeper into the analysis. So this, you'll see, is the trailing performance starting from 2019. Strong first 3 years, and then last couple of years have been more challenging, which I'll go into a little bit more, have gone into a lot of detail, so won't cover all in detail this time, but would give some peer group comparisons this time. So since inception, it's been a very strong run in the market at about 17%. Net of fees, the teams delivered 18.5. So gross would be about 20. Obviously, not many time periods in Indian markets history where over a 5-year period, market would have compounded it closer to 17%. So cumulative net 144 compared to 125, 1900 basis points cumulative alpha, 180 plus basis points annualized alpha. Just give me 1 second. This is since inception market cap attribution. You'll see overall 47. This is gross of fees and tax. So 172% return. So obviously, when compounded over time, tax and fees and brokerage costs and all those add up. So 144 is net, 172 gross compared to 125 the benchmark, 47% alpha, 46 of that comes from stock selection, hardly anything because of allocation effect. Performance in each category, as this graph shows, has been solid compared to the comparable benchmark. So on average, we are about 60% of the portfolio in large cap, which is probably somewhat higher than a lot of the other multi-cap managers. So it's more of a flexi cap product, and about 40% is in mid and small combined. On a sectoral attribution perspective, also 172 versus 125, you'll see 47% alpha, 45 of this has come from stock selection, positive again across almost every sector. If you look at the top 10 contributors and detractors over the last 5 or nearly a little over 5 years, you'll see very good distribution. No single name has made or can make or break performance. Good distribution from across sectors. There's several IT or at least one IT services name, and this is more of a new age name. There is, pharma names, 3 of them, chemical, Bajaj Finance, Nestle, Chola, so a couple of 3 finance name, Muthoot Finance as well. So 3 NBFCs and 3 pharma, Torrent, Abbott, Ipca. So very well distributed. There are obviously several detractors as well. Good to see that the top detractor is smaller than the 10th largest contributor and against very well distributed. So on the negative side also, the risk management and position sizing has been well at work. No single name has been able to dig a big hole in portfolio performance. Now coming to the year that was last year. Certainly performance, this is on gross of fees and transaction cost basis. So 25% compared to 26 minus 1% alpha. Selection effect was more negative. Allocation, it helped that we had more in mid and small, about 40% compared to about 24% of the benchmark. But selection effect, you'll see later on as I'll highlight at a later point what contributed to the negative selection effect. Same thing, story with sectoral attribution, minus 1.1, of which sectoral allocation effect was positive, minus 3.8 was the selection effect. Top contributors and detractors, again, couple of IT names, Nestle, Chola, and so on. On the negative side, Ambuja Cement, which at the start of the year was a fairly large position and has ended the year with a fairly large position. But in the interim, post the Hindenburg report, took a big knock at the time. And then you see some other names here, including Vedant and Dixon, which are now ICICI is up 13%, but up 13% in a market that was up 25%. Led to a detraction in the portfolio. This is a portfolio composition at the end of the year, consistent with the past. There's nothing invested in energy and utilities. Financials in absolute terms remains the largest weight, followed by consumer discretionary, and now industrials, as we've spoken before on such forums, has grown in weight. Also healthcare is a fairly good allocation compared to the benchmark, at least. On market cap, 55% in large, 44% in mid and small. We've added an additional, as you can see here, we've added an additional categorization because that's become a very important one from a risk exposure perspective. Yeah, we always used to look at sector and shared sector and market cap. But over the last few years, these exposures have driven the market returns. So conglomerates here are old economy or family run or entrepreneurially run conglomerates. That makes up about 12% of the benchmark. So it includes, obviously, one of the biggest weights would be Reliance, then the Birla Group, Jindal Group, Adani Group. Those would be the key players here. And then PSUs, which are almost similar in weight. These two put together are north of 22% of the benchmark. In the portfolio, in the past, as many of you would have heard from us, and in our risk analysis and attribution analysis also would have shared, in the past, we used to have zero exposure to these, but from a risk management perspective, we have 5% now in PSUs and 4% in these conglomerates, collectively 9%. So still a 13% underweight, but in absolute terms, we now have a 9% weight. Now, remember, this weightage has increased quite considerably over the last 3 years. 3 years ago, the PSUs were approximately half the size, and conglomerates were lower as well, I believe. And so our underweight was high back in 21, very high in 21. Now also the underweight is about 13%, but somewhat lower than what it would have been earlier. And we'll share, just give me 1 second. I'm going to, at this stage, just pull up another slide to show what was the underweight back then. Just give me 10 more seconds. I'm just opening up. Sunanda, is the new screen visible? A new deck visible,
Yes,
which
Prashant,
shows...
actually the WhiteOak group slide is visible at the moment.
Yes, exactly. So let me just go back to the right slide. Yeah. So as you can see here, in 2021, December 2021, conglomerates made up about 12.8% of the benchmark, SOEs about 7%. So they were about collectively about 20% back then. And we were zero. Almost zero, only 0.3%. There was a small weight, I believe, in BEML, as it was a privatization candidate. And overall, the sectors which include your utilities, real estate, as well as SOEs and commodities, they made up 28% of the benchmark, and we had hardly any exposure to them. Today, these sectors having outperformed, they made up 32% of the benchmark, and we have 13%. So our underweight has reduced from 28% to 19%. This has been one of the key changes over the last couple of years that we've gradually done, recognizing that it is too high a risk in the context of balanced portfolio construction and more consistent performance. This is too high a risk to tolerate. Going back to now the portfolio composition slide. So let's look at the performance, because we just covered in detail the pioneers' performance. But if you look at performance across, these are obviously on the call, we have people who are invested in various different strategies, though pioneers is the largest, but obviously the AIFs are very large as well. And these are the performances of AIFs. So some of the AIFs have done better in 2023 compared to the pioneers, largely because the AIFs have more small cap. As they're closed-ended fund, they can bear less, or they can own stocks that are less liquid, which tend to be smaller. And since small caps did very well last year and somewhat higher to the tune of 5 percentage points extra small cap in AIFs, has led to somewhat better returns in AIFs than in pioneers. And then that's true across, I would say, PMS universe. The small cap PMSs, we don't run a small cap alone, small cap PMS, as we believe it's a very high risk strategy, especially to be opened in a PMS format. If at all we were to offer a small cap product, it would be more in an AIF format, so as to safeguard from massive liquidity risk. We in fact didn't launch our on the MF side as well, small cap, and on the mid cap we launched an SIP only because of the nature of those asset classes. But there are several PMSs that are small caps only, as many of you might be aware. Those have had a terrific run last year, as small caps did extraordinarily well overall. There's also the performance shown here of the emerging market strategy, as many of you are invested in our EM fund as well through LRS. That's had a fantastic year last year. This was a USD, this is USD term returns, 17% compared to 9% of the benchmark. So very strong outperformance. And since inception, annualized 9.4% return compared to minus 0.7 of the benchmark. So 10% annualized alpha. It's only been 18 months, but a very strong start, because globally, unlike global markets are in a very different state of the cycle today than Indian market. Whereas in India market, you are seeing this sharp rally in PSUs and in this particular set of sectors, the domestic cyclicals. That's not necessarily the case globally. So that factor headwind, if you will, is not hurting us. So this overall just shows what we already discussed. So over since inception, portfolio has delivered solid alpha. I'm going to delve a little bit deeper on the performance element. This graph might be familiar to many of you, but before I come to this, let me share with you some more on peer group performance. Yeah. So what we saw just now was, since our inception over here, if you were to focus on this column for now, 18.4% return. And then what we've shown here is S&P 500 and then peer group, a dozen other peer group. So since inception, we've obviously hidden the name of the peers, but we've only given the indication of whether their AUM is more than 5,000 crores or less than 5,000 crore in this column. Yeah. If you look at our performance since inception at 18.4, it ranks second. Obviously, we'd love to be on number one, but 5-6 years is still a relatively short time frame in the world of investing. So quite satisfied or happy with since inception performance of the team at 18.4%. If last 6 years or so, if you were, so this is since, you know, our inception in 2017. Okay. There have been distinct phases in the market. 18-19 were years when small caps did terribly, as many of you would remember. At the same time, poor governance did terribly. In that kind of environment, our strategy, when poor governance did very poorly, and as I was sharing earlier, we had no exposure to what can be loosely classified as poor governance, we did extremely well, and we were the best performing strategy at 8.2. The second best was 7 over here, and then the third was 5, and so on and so forth. Yeah. Remember, the sorting is done based on since inception, 6 years plus performance. But what we are showing now here is just the performance during the early time period from till 2019, or in fact, it is just 2018 and 2019 when poor governance did very poorly, and small and mid cap did very poorly. Since we have a flex balanced portfolio, but with a governance tilt, we did extraordinarily well, ranking number 1 during this time. Now, over the next 2 years, governance wasn't a strong factor. Yeah. And I'll share this slide over here to highlight that. So if you see, when we started in 2017 with an index, let's say the red line is good governance versus poor governance with an index of 100. At the end of 2017, the index was 102. Yeah. And then by the end of 2019, that index had gone to about 118. Yeah. So good governance did very well, outperforming the poor governance sectors by about 18 points. And then while in the interim, it peaked, but by the end of 21, it was again at 117.2. So 118, 117, as I was saying, between 2020 and 2021, end of 19 to end of 21, it was governance was a factor was flattish. And then since then, there has been a massive collapse in this line, as you can see, as poor governance has done far better than good governance. This 117 has slided down to presently 87, about a 30 points drop or 25% underperformance, one of the sharpest in history. So if you look at our performance broken down during these different time periods, first, if you look at August 17 to December 23, which is the entire period, the performance of the strategy was 228 compared to 144, 87% alpha. 115 is from stock selection, 28% is because of what we consider as third and fourth quartile by business characteristics, which is largely driven by governance. And first 3 years, we benefited by this factor. Overall alpha of 62%, 49.6 coming from stock selection, and 12% was allocation effect. In the next 3 years, while overall alpha was -10, a big chunk of it, -25, has come from the poor governance doing very well. As you can see here as well, the fourth quartile in the benchmark has trounced the top quartile during the last 3 years. Whereas if you see the first 3 years, the top quartile trounced the bottom quartile in the benchmark. So even though, we did well in some of these quartiles, in the better governed quartiles at least, the overall performance was very skewed towards the poorly governed segments of the market. And if I were to relate this then back to the peer group that you see here, Jan 20 to 21 being hardly any impact of governance, you'll see that we have still done respectably well. We were first in these 2-year periods, fourth in the next 2-year periods. This manager was first, who was in the first 2-year period third from the bottom. And then last 2 years, when poor governance has done extremely well, at that time, you'll see that some of the other managers, so it's very interesting. If you see here, the manager who's done the best, he unfortunately wasn't present during these 2 years to be able to, in 18 to be able to evaluate. But the second best manager over the last 2 years was the very worst manager during 2018-19, delivering a -17% return annualized compared to +8% at that time. So that being the case, now if you look at 22-23, last 2 years, we are middle of the pack. We are 7th on a list of 13 managers, including ourselves. So that including ourselves, there are 13 managers. So we are 7th here in a time period where governance has been a huge headwind to us. We were 4th when it was neither a headwind nor a tailwind over a 2-year period. And we were first when governance did well in the market, and we were 2nd overall. Yeah. Now, investors oftentimes think a year is a long time period. 2 years long time period. Now, what happens is when 2 years are strong, trailing 3-year also appears strong. Yeah. So at this time frame, which is here, investors looking backwards would have been, pulling money out of managers like this one and putting money in with managers like these. Yeah. And the reverse is very tempting at this time, as managers rush or investors rush into putting money in those who are doing extremely well over the last 2-3 years, possibly taking money out from those who are doing poorly over the last 2-3 years. You can see this another example. Last 2 years, this manager is 2nd from the bottom over here, but actually was the best performing manager in 2019. Unfortunately, they started late, they don't have 2018 performance, but they were the best performing manager in 2019, would have gained considerable scale and hence more than 5,000. But in an environment in 22 and 23, when good governance is not being rewarded, but rather the worst of the governance is being rewarded, they're second from the bottom. So I just want to highlight this for everyone here to be mindful when chasing the most recent year's performance, that most recent year's performance could be driven by some of these style factors in the market and may not be sustainable over long period. So what is advisable, which is what globally institutions do, is look at over far longer time periods comprising of full cycles, market cycles, so that you have time periods when mid caps have done terribly, mid caps have done extremely well, time periods when good governance has done extremely well, and time periods when poor governance is extremely well. So if you look at this time period here, good governance did well, and then good governance done very poorly. Yeah, mid caps did very poorly, and then now mid caps is doing well. So I'm not sure. It is in fact not a full cycle so far, because at some point this would stop and turn again. And when it crosses 100 again, that would be a full cycle. We don't know. Maybe we are at the bottom and would turn from here. That's the problem with the cycles. You can only see in hindsight where you were. But by extrapolating what's happened just over the last 3 years, or any investor, by chasing these past 2-3 year returns, are susceptible to just chasing the returns of the past rather than forward looking. Another way to look at same thing, different form of data, look at 2017 sectors that did extraordinarily well. Real estate led. So overall the market was up 37%. Last year market was up 27%. Yeah, real estate was the best performing sector, 108% up, led by large caps 135, mid cap 118, small cap also 79, followed closely by materials, industrials, and consumer discretionary in that order. This time, again, real estate has led the charge in 23, and then followed by PSUs and industrials. So a couple of differences are there. Materials haven't done so well, nor has consumer discretionary done respectively overall, but led really by real estate and PSU. And real estate and PSUs, I think I mean, most people would agree, generally are classified in poor governance category. And then in 2018, it reversed, as real estate was the worst performing sector. PSUs were also beaten up. Consumer discretionary also from a high got beat up in 2018. So these outperformers in the market can turn into poor performers very quickly, and just betting on extrapolation may not be the most sensible. I am not suggesting to bet on the reverse is a good idea, but either way, you don't bet on these macro or factor trends in either direction. This just shows that in our portfolio, generally speaking, the top 2 quartiles of governance have tended to be the highest exposure. Yeah. We started in 2017 with more of a balanced portfolio. Unfortunately, this was the time when poor governance did very poorly, but we had somewhat higher amounts of those. We ended up going to, and we've talked about all this in the past conversations, that we ended up going to one extreme, which is had almost nothing in poor governance segments. And as I highlighted a few minutes ago, we've since then added to balance the risk somewhat more. To give you an illustration of what the quartile 1 and quartile 4 of the performance that we discussed earlier on this slide, what are the sampling of companies into quartile 1 and quartile 4? This would look the sampling of quartile 1, and this would be the sampling of quartile 4, with several being SOEs, in the 5 out of 10 being SOEs in quartile 4. So I'm going to, at this time, see if there is anything there are a lot of things here that I can go. This is a composition of the portfolio, as I shared earlier. As of today, some of the changes made by the team over the last 1 year includes, industrial names like ABB India, Bharat Electronics, Hindustan Aeronautics, obviously two SOEs, which fortunately have done very well in the portfolio, but others also like Mankind, Pharma, which was a new listing, couple of IT services names in there as well, and some of the names that we have exited listed here. Happy to go through. This also, by the way, while I earlier showed the peer group performance relative to the domestic group, this is for the UCITS, and some of the investors on the call today are invested in the UCITS as well, and probably will be more familiar with this data. In the foreign funds, as I said, we have garnered strong inflows. We are, since inception, the best performing UCITS at 121% return compared to, this is cumulative, compared to 100% the second best, and so on and so forth. And since inception of the strategy, again at the top of the peer group. Again, the same story, that during August 17 to 2020 at 74% return, we were a huge long way ahead of the second best, which was at 48%. And over December 20 to December 23, last 3 years, we are at 43%, which is again middle of the pack, about 12th ranked on a list of 25 names, just better than the average, but top of the peer group when you look at the entire cycle of sorts, if you will. Very interesting, the worst performing manager during 2018-2019 year as well, who had delivered minus 18% return, at a time when we delivered 74% return, plus 74, and that manager delivered minus 18. In the last 3 years, that manager is the best performer at plus 78, and we are 43. If you take it over the entire time period, this means that we are plus 148 or plus 149, and the other manager is just 45. However, if you were to look at just the last 3 years, this manager at plus 78 would seem to be a far superior manager than we are. And certainly they've garnered more inflows than we have, at least in a percentage terms, though overall, obviously, our AUM is far higher than that manager, as investors globally look more at a full cycle than over short windows. So I know we've covered already 40 minutes of the session, so I want to now pause and open up for Q&A for the next 35 minutes or so, and we'll aim to close with an hour and 15 minutes. And I have my team members as well, who will join us, Parag and Rohit, in answering any portfolio-specific questions you may have.
Sure, Prashant. Thank you, Prashant, for your insights. Like you said, we now move over to the Q&A. I request the audience to post their questions on the Q&A chat box. We've already received a few questions, and the first one is for you, Prashant. You mentioned when you were talking about robust flows from foreign investors and foreign interest picking up. You've been managing money overseas for decades now. What is the outsider perspective on India today?
It is very positive. In the last 17 odd years that I've been managing professionally my India assets, I've never seen foreign sentiment as positive as it is today. Yeah. It can be thought of as a positive or a negative. I'd like to see it more as a positive. I think over the coming few months, you'll see massive inflows into India. I don't know whether that would necessarily cause the market to go higher, but certainly it's good to have more money come into India. As it's good for the country, it's good for our industry, and it's good for everyone, including us. But our expectation, based on the number of inquiries, the number of client requests for meetings, and the number of client trips to Mumbai to meet with our team and to Singapore to meet with other team members based here, are at historical high levels. Certainly good for the Indian tourism sector as well.
Okay, sounds good. Next question is for you, Parag. RBI is very strict with respect to digital regulation, as you can see in their action on Paytm and Bajaj Finance credit cards. What's your take on this?
Sure. I mean, interesting actions by RBI in last 2-3 months or so. So see, if you look at, banking or lending has changed considerably in last 5-7 years. Customer onboarding, KYC, transactions are now online. Rather, the customer is always doing transaction on mobile. Therefore, for any organization, the digital infrastructure, the checks and balance they have for transaction for KYC is very, very important. And if there are losses, impact could be material because the fault gets multiplied or applied to the entire system. Or let's say if there is a problem in the onboarding of customer through KYC, if that system is faulty, it applies to the all customers onboarded through that route, right? Rather than the earlier system where it was paper based. So the KYC mistakes could be with respect to that particular case rather than the entire system. So therefore, it is necessary to close the system or customer onboarding till the time the mistakes are rectified or satisfied to the regulator. So I think same has been done by RBI in the current case of Paytm or if you look at the earlier case of Bajaj Finance or HDFC Bank where their cards onboarding was stopped. So it is more about having system of onboarding KYC in a robust manner rather than anything to do with any particular organization.
Sure. Okay, thanks, Parag. The next question is for you, Rohit. Actually, there are two questions. One is that we have exited campus. So is there any concern of discretionary spending and earnings potential? And will that also impact certain other stocks like Vedant, Titan, etc.? And the second question is, why have the discretionary consumption trends been weak lately?
Sure. So sort of related questions. On the first one, our exit from campus is not about us being worried about the discretionary consumption potential in this country. We remain, very, very positive on the long-term discretionary consumption potential as GDP, per capita grows, disposable income grows, aspirations are on the rise. Internet has in fact democratized aspirations. You're seeing access to a lot of discretionary consumption categories improve thanks to expanding offline distribution and retail penetration, as also e-commerce players now reaching pretty much all of India, right? Almost 95% of pin codes in India. So all the let's say pieces of the puzzle are falling in place and discretionary consumption, but the cyclical nature of growth is captured in the word discretionary itself. Right? When there is pressure on disposable income because of inflation in essentials, your daily use commodities, more staple, part of the consumption, the customer or the household has to then make a choice on where does this reduced disposable income grow. So there is a wallet share shift that can happen between categories, and that's why you see divergent trends in various discretionary consumption categories. The jewelry is doing well, tourism sector, the entire travel, leisure, that segment of the market is doing extremely well. But some of the other discretionary consumption categories, whether it is eating out, as you see in the case of QSR companies, smartphones as a segment is actually doing extremely well, with both decent volume growth, but significant rise in average selling prices of smartphones in the country. So people are buying better phones and continue to do so even in 2023. So the dichotomy is really about wallet share shifts. It is not that overall discretionary consumption is collapsing in the country. It has slowed down because of some pressure on disposable income, but pockets of the economy continue to do well. Insofar as a specific us exiting a specific company and entering something else. I mean, for example, we added Zomato to the portfolio, right? That's also in the discretionary consumption space. It's an internet company, but a play on discretionary consumption, right? Which is eating out and quick commerce in some sense. So to that extent, it's more company specific. There were a couple of areas where we were, sort of for the performance of the company or decisions taken by the campus management were sort of not in line with our expectations or what we thought the company should be doing, and that prompted that decision. So it's more company specific than any reflection of our views on the discretionary consumption part of the economy.
Sunanda, while we have Rohit, should we also, there's another question on views on turnaround stocks like Zomato and Suzlon. Suzlon we don't own, so maybe we can skip that one.
Sure.
But Zomato, maybe Rohit, you can address while you have the floor.
Sure, Prashant.
Zomato.
So, yeah, Zomato, interesting that, kind of written off or people became, sort of fairly negative on the company reasonably soon. The funding winter that happened in 2022, pressure on the startup ecosystem, and the global fall in this startup valuations, both listed and unlisted, right, added to this negative sentiment on the stock through 2022 and part of 2023. The company, in the meanwhile, continued to improve its unit economics. And the big question mark, or let's say the optionality of quick commerce business, which they entered through acquiring Blinkit, right? That optionality has turned out to be a positive one. That business has shaped up extremely well. And it was a question mark in our minds as well, whether, this proposition of quick commerce, 15-minute delivery will take off or not. What would be the consumer, household adoption of the service? But all the three players in the market, whether it is Blinkit, Swiggy, Instamart, or Zepto, all of them are doing well. This is about to overtake slotted delivery as the largest, part of the e-commerce, grocery e-commerce pie. Both are right now, in the 39 to 41% range, and quick commerce has now become close to $3.5 billion in gross merchandising value annualized, right? So very, very quick, and you have to remember this is only a 3-year-old business in some sense. So positive surprise on that side, improving unit economics on the food delivery side, acceptance of certain components of this unit economics improvement, whether it is the delivery fee that they started charging customers, now platform fee that they've started charging customers. These are small numbers, 2 to 5 rupees per order. But there is consumer acceptance of this, rising take rates, in the restaurant space. So overall unit economics and then some cost measures as well. So significant, delta in unit economics, quick commerce shaping up well, and a couple of optionalities still existing in the form of their hyper pure and dining out business. So can this, is this a business to like and own? Absolutely.
So maybe while Sunanda, maybe I can quickly fire away the questions. I want to make sure we cover each and every question. Try and cover at least each and every question, but I think there are some 50 plus questions, and we should try and cover them in 23 remaining minutes, if I'm not mistaken, calculating properly. So maybe rapid fire, Rohit. There are more questions for you.
Sure.
So think of it as 20-30 seconds on average per question. Your views on renewable energy sector and the move going forward, given the positive government outlook of the sector.
Yeah, the sector will grow very large. The government has plans, but whether this growth translates into returns for investors remains to be seen. These are capital intensive sectors. We saw this in telecom. Massive growth, huge investments, but very few winners from a market standpoint. So that remains to be seen. But growth in the sector will remain very healthy for next many years.
Again, for you, what are your views on discretionary luxury consumption theme? For example, luxury watches, luxury cars, as per capita increases in coming decade? How do you intend to play this luxury discretionary place?
These are not just for the next decade. These are multi-decadal plays in India. We're just getting started, right? As the proportion of India A plus households, right, as characterized in certain ways, high income households grows, luxury consumption is going to grow. It's a very low base today. It's not sizable, right? And of this low base, it's going to grow. How are we going to play it? We will look at, we have Titan in our portfolio, which in a way is a play on let's call it premium to luxury consumption, right? They have a format called Zoya, which is luxury jewelry. So we continue to look at opportunities here. There is one listed luxury watch player as well, which we don't own, but we continue to evaluate all such opportunities. We are positive on the growth potential here.
I'll come back to you, Rohit, in a minute, but in the meanwhile, maybe ask Parag one on ICICI. What's your long-term view on ICICI Bank? Buy, stock, buy, hold, or sell? I don't know whether you want to go that specific, but just view on ICICI Bank in short.
No, I think it's a great franchise. If you look at post this corporate debacle which they had earlier, I think they have done extremely well on all the parameters, whether it is digital, whether it is underwriting, whether it is growth, margin. I think, and they are continuing to deliver on the numbers. And as you know, we have time and again said that if you look at the landing as an opportunity, would be 2-3% better than the nominal GDP. Privates will again grow 2-3% better than the industry, and somebody like ICICI will continue to deliver fantastic results. So we will. We are very positive, and we'll continue to.
Let's say we expect ICICI Bank to continue to deliver fantastic results.
Yes.
Quickly on Rohit, back to you. A lot more questions on consumers, surprisingly. So as consumer demand in the rural areas grows, just by the way, on luxury, I want to point out that in those who are invested in our emerging market fund know luxury names like LVMH, Hermes, Richemont, which owns Cartier, and so on. They are the largest positions in our emerging market fund, even though they're developed market companies, but bulk of their value, 2/3 of their value is derived from countries like China, Asia, and going forward, increasingly India. So just wanted to add that we are, as Rohit mentioned, luxury is a multi-decade opportunity in India and globally. But back to consumer demand, Rohit, as consumer demand in the rural areas grows, is it possible that mid caps will continue to do better?
I'm not certain of the linkage between the two because, if anything, companies that have a higher share of the rural consumption, it's actually the larger companies. Let's say staples, right? It's either the larger organized companies that are present, through their deep distribution network, or it is a local or regional unlisted player who's serving that market. The smaller national listed players or smaller listed players, mid-sized listed players, do not have as deep a rural distribution network as the larger players. So the linkage that is assumed in this question is something that I do not agree with.
Sure. Now I'm going to answer. There are a lot of specific questions, and I'm going to answer, and I'll try to answer all, and maybe in between. Can you see the screen here again?
Yes, Prashant. The
Yeah.
distribution of alpha is visible.
Okay.
Slide.
This is the distribution of alpha. Yeah. So there's a question on why holding Nykaa and Sequence Science, Metropolis, Indigo Paint, etc., etc. List of underperforming stocks is large. Well, that is maybe specific observations, sir. Your specific observations are right, but what the fact here you see on the screen is that the team over the last many years have got 61% strike rate, which is, I think, unparalleled in the industry over long term. I don't think the greatest of the investors around the world would have done any better on this. Generally speaking, more than 50% is an expert, if not a guru. So 61% strike rate in an industry, in our business, is extraordinary and outlier. That means 39% of the companies that we have invested have underperformed the market during the time that we've invested, and 61% have outperformed. So the names that you have listed do fall in that 39%, but the strike rate is still better than anyone else out there, would be my submission here. So it's like, you can ask Bajaj Finance that, you can find probably 100,000 different loans that they've given that have gone bad, that they've not recovered, that been NPAs or written off. But the reason Bajaj Finance is because they do it, their proportion of such loans is lower than everyone else, and the money that they make out of where they are right far more than offsets where they go wrong. So same way, the money that where we are right far more than offsets where we go wrong, which also you see here that on the right hand side where we outperformed, the alpha in the outperforming names are as high as 500, 600, 700, 800, even 900 basis points. Whereas where we underperform, it's a, first of all, small tail, and the size is also very short. So while your observations on the specific names are true, there is no one in the world, there exists no manager in the world who don't have in their portfolio underperforming names. Next question. On the budget, what are your thoughts on 1 lakh crores allocation with low interest for innovation R&D? It's positive. There's nothing negative. There have been schemes like this in the past as well. It's not something that's going to be earth-shattering, but yeah, it is continuation of certain similar policies, and it's a positive on that front as long as it's deployed appropriately. How much percentage of AUM increased in last 3? Hold on a second. I'm not able to read this question fully.
Prashant,
repeat the question?
Prashant is asking that how much of the AUM has, how much percentage proportion of AUM has increased in the last 3 years when WhiteOak hasn't performed at part with the Sensex?
Okay. Yeah. So see, there is a saying, no, like as soon as a sparrow or a crow sits on the branch and the branch falls, and you might be tempted to think, oh, the sparrow is so heavy that the branch is broken. Yeah, so there can be a lot of things that happen coincidentally. I think we went over some of the reasons why the underperformance has been there. And having said that, over the last 6 years, very strong performance, and even over the last 2 years, it is middle of the pack. It's not like at the bottom of the pile or anything like that. Not that we are very excited or happy about it, but that is investing. You can't expect, just like you can't expect a Tendulkar or a Kohli to score top of everyone in every single match or in every single series. There'll be some times that someone would do better, and other times others would do better. But over a period of time, over multiple series, multiple years, the better players would deliver higher returns, higher alpha, just as our team has delivered. In fact, if size were a constraint, if you know the mutual fund industry, I'm sure you're aware, amongst the largest of the mutual funds have had the strongest of the performance over the last couple of years. They were the same mutual funds who had a terrible performance maybe over the prior years, but last 2 years, they had the largest performance. So if scale were the key reason, I'm not saying scale is not important. I'm an important factor. All else equal, the larger the AUM, the more difficult it is to generate the same alpha. But all else is never equal. Yeah, we, for example, have over the last 5 years gone from, or over the last 3 years, in 2020, we were a 10-member team. Today, we are a 45-member team, of which 33 are involved in India research and investing. See, team size also is a big contributor to how much money you can manage, and the caliber of the team, very importantly, as well. On the budget, I already talked about. I'm just going to be, in the interest of time, run through very quickly. But to give you a specific answer, over the last 3 years, I believe our AUM would have doubled. Yeah, but obviously the markets have gone up also very nicely. But yes, our AUM would have done better than, more than double. I think it was at the end of 2023 billion. So currently at 7 odd billion, it would be more than double. I'm not seeing anywhere near 18% CAGR as mentioned by your presentation. I invested in Pioneers Equity starting October 21. And trusting WhiteOak team, can you help understand what I can expect? So again, point-to-point returns are very 21. Obviously, at the end of 21, the market was at an interim peak. From the end of 21, the market itself might not have delivered 18% CAGR. October or November of 21, the market had peaked. So point-to-point returns can be very different. What we are talking about is compounded returns and over multi-year time frame. If you take, unfortunately, if someone has invested in a strategy at the highest point in terms of absolute return, then the returns would not be the same as the return on the full year. What can you understand going for? What can you expect going forward? See, the market expectations, I've always said, is reasonable to expect 10 to 12% return from the market over long periods of time, which is in line with nominal GDP growth rate. Historically, the team has delivered, mid to high single digits alpha since over cycles. Yeah, but maybe going forward, alpha generation would be more difficult in the industry. Our aim is to generate higher alpha than anybody else in the industry. You saw over the last 6.5 years, at least in that list of all credible, I think it is all PMS schemes that have more than 1,500 crores or 2,000 crores of AUM that have been around for some time. They're second on the list. We shoot to be number one over long periods of time. If alpha itself is less in the market, we might have lesser alpha. Yeah. Let me go to quickly. Why for last 3 years alpha is continuously negative? So we went over this question. I'm not going to rehash that, but last 2 years in particular were challenging. 21 was positive. Last 2 years we saw, and all the reasons I'm not going to rehash about the governance and whatnot, because I think the question was typed at the beginning of the, so I'm going through all the questions since the beginning of the session. So the question might not have been addressed when it was typed, but subsequently, I believe we've addressed the question. The performance was lesser than benchmark in last 1 year. What are the reasons? What is being done to rectify? I think this is, again, I'm looking at the timestamp. I think the time the question was written was before the question was already answered. Your MF portfolios have 100 plus stocks vis-a-vis fewer stocks with other AMCs. Would 100+% stock be considered overdrives? I hope you're not compromising on the upside. I hope you were able to, sir, attend the session where we went over the myth of concentrated portfolios. At the end of this session, we will, Dipojal, if you can bring up that slide, which shows Peter Lynch, who's the best known fund manager across the world of all times, generating about 1,300 basis points of alpha over a period of 13 years in the US market. He used to, on average, own over 200 names in the portfolio. Yeah. And there's a lot more that slide would show, but in the interest of time, I'm not going to interrupt right now and ask Dipojal to share that slide. But Dipojal, at the end of the
so sorry, I'm not able to share it because I think you're sharing it.
Okay, you are not able to share it. Okay, now I'll pull it up towards the. Okay, let me see if I can.
It is in this deck only, Prashant, slide number 92. Yeah.
Slide number 92, is it? That's good. Let me just go to slide 92. So stop me if you see I'm approaching it. Huh? I am not able to see the slide.
Yeah, Prashant, you're on 80th right now. So,
80th.
yeah, Prashant, you're on 90. Yeah.
Okay, 91, 92. Yeah, so 91. So as you can see here, sir, this is from the very famous book, One Up on Wall Street. How many stocks is too many is the section that Peter Lynch writes this. He says that when he took the Fidelity Magellan, it had 20 million in assets. There were only 40 stocks in the portfolio, and Ned Johnson, the family which owns Fidelity and the person who was running that portfolio, he says, I recommend that you reduce the number to 25. Peter Lynch says, I listened politely and then went out and raised the number to 60. 6 months later to 100 stocks, and soon after that to 150 stocks. Yeah. The point is not to rely on any fixed number of stocks, but rather to investigate how good they are on a case-by-case basis. His average number of stocks were 200 during the 1997 to 1990 timeframe, where he outperformed by, as you can see, 12 percentage points. There's a lot more to this. In the interest of time, not going into the details of all of that. It's not everybody's cup of tea to run a portfolio of 100 names or more. It is a luxury that we can at WhiteOak afford by virtue of the resources that we've deployed for research purposes. If you have 5-member, 10-member team, it may not be optimal to have more than 100 names. It may be optimal to have a 20, 30 or 40 name portfolio. But if you have a 100 plus, if you have a 30-member team, you can generate greater alpha by having a larger investable universe and exploring and incorporating alpha opportunities even at smaller position sizes, which then means larger number of names. I have covered this on number of occasions, and there was a session specifically on number of names. There was one of the quarterly webinars specifically on number of names. If you're interested, we'll certainly be very glad to email you a link to that recording. But in the interest of time, we'll pause here on this. When do you expect rate cuts by US Fed, and RBI. By US Fed, middle of the year, by June, and I think RBI would likely be concurrent or follow soon, or maybe right around that time. Next question says the portfolio has low exposure to PSUs, utilities, and energy. Has this stance not hurt the performance? As last 1.5 years, the portfolio has not beaten benchmark. Do you feel going forward you would stick to the strategy even if it means underperforming the benchmark? Look, first of all, yes, over the last 2 years, as we discussed, yeah, not owning these segments, PSUs, utilities, energy, and all, have hurt the portfolio quite considerably. Plus, what has happened is, as these segments have done better, their weight has gone up in the benchmark. Yeah, so the underweight has further increased. So not just these, but there are other segments as well which we didn't own. We have, to reduce the risk over the last year and a half or two, been gradually increasing. And some of the examples I can share further. I shared some of the adds and exits over the last 1 year, but even over the last 1.5 years, if you were to or over a somewhat longer time period, you'll see there are some of these lists of names that have been added. Data patents in defense, CG Power, usually, I mean, they supply into utilities, Grindwell, Container Corp, Craftsman, Larsen Toubro, so on and so forth. Yeah, so they either are directly in that industry or are linked to the fortune of that industry, and that has mitigated this risk. And as you'll see on the rightmost column, most of these names have given positive relative return, and that's why last year was better than prior year. And that is one of the reasons many of the fund managers who have a strong corporate governance tilt or style like we do, they unfortunately did worse last year, and our underperformance wasn't as much. As I was sharing, over the last 2 years, we are middle of the pack. Please don't forget, while underperformance is there, we are middle of the pack. Yeah, and it is partly due to the risk mitigation, that why over the last 2 years we are able to be middle of the pack, because the team has balanced the risk by adding to some extent. We haven't bet the whole hog and gone overweight pieces because we don't know what the next 2 years bring. Remember 2017, real estate, PSUs, industrials, infrastructure did fantastically well, only to be clobbered next year. So these are things which are inherently unpredictable. You can manage the risk, but not advisable to bet on such top-down bets. I don't know whether Sunanda, because the questions keep adding up. Now there are over 60, so I don't know whether we'll be able to go up, but I'm going to go through till you kick me out here. We have 3 minutes to schedule time. Maybe I'll go over some of these are now repetition. Select the question and reply the same. They've given example of some PMS manager who's given 35% return. I don't know over what time frame or whatnot, but yes, there are managers of all hues, and some might have given over some time. If you go back to 2013 to 2017 time frame, from Modi's election till the peak in January 2018, I would strongly request you, I will request all of you who are in attendance today to go look for the best performing manager from 2013 to January or from August 2013 when Modi ji was nominated to January 2018. Look for the best performing manager. Look for the top 10 best performing manager during that time, and then look at what their returns were in 2018 and 19. I would bet each of those 10, not 9 out of 10, not 8 out of 10, each of those 10 would be bottom of the pile or close to the bottom of the pile in 2018. So a 35% return, I don't know whether this is small cap manager or what kind of a manager or what time period, but what I'm telling you is from managers who would have given top of the peer group returns over a 4-year period, from mid 13 to Jan 18 would be bottom of the pile in 18 and 19. So just past returns without proper context and analysis on how the performance has been generated doesn't mean much, unfortunately. Please share the presentation if possible. Please reach out to our team, please email and we would share it. What is meant by governance? What do you mean by poor governance? Please explain. So just let me, sorry, I thought these are slides that we have gone over in the past, so I did not belabor on this, but we have a very well thought out framework on governance. These are the forms of misgovernance according to us. Broadly, 5 categories: cheating existing partners, meaning companies that are taking money, promoters who are taking money out of the company, siphoning of cash or value. I don't want to go to individual companies, but yes, if you think of decades ago, or at least a decade ago, a lot of with United Spirits, United Breweries, they were blamed for allegedly taking money out there. Conflicted related party transactions, having multiple businesses in multiple companies in similar business, some privately held, so on and so forth. Cheating investors is about at large, which is about stock price manipulation. You rig up the stock price, followed by that, you do secondary offering, or even worse, the management has their own stock in the names of different people. They sell in the market. So even today, we don't own any of these, despite many of these stocks having done fantastically well, particularly over the last 12 to 18 months. Then there is unethical or illegal business conduct. Okay, now, self-explanatory. There are, again, I can't name specific names, so won't belabor on that. Misaligned interest or objectives are typically companies where, look, PSUs, they don't necessarily exist to maximize returns for shareholders. They have other social objectives and whatnot. So most of the PSUs fall under this category. And poor accounting is self-explanatory. So of the names that we've added, they would fall predominantly in this category and some in this category. Yeah. So these 2 is where we have added in terms of risk mitigation, because these 2 are all 5 have done extraordinarily well over the, let me be clear, all 5 over the last 3 years, or 2 years in particular, have done fabulously well. To mitigate risk, we have invested more in this. Poor accounting plagues everyone to some extent or the other. We correct for that. And many of the companies have, multiple such factors impacting them. Now, there is a very long question. I'm trying to just not go through the entire thing, but they have, basically the question says that they invested in December 21, and so performance has been weak since December 21. Yes, ma'am, we agree, and we went over through the reasons why that is the case, and I hope this was helpful in your to explain why the performance has been poor over the last 2 years. My request would be just that look at longer term time cycle. It is unfortunate that we didn't reach out to you earlier and could not get your investment early on, but those who would have invested very early on, they would have had a much more positive experience at this time. We are the same team. You've asked for what should you do going forward. It's really not, I would obviously be inclined to say you stay with our team, but it's really a decision you all have to make at this point in time. Evaluate us compared to other opportunities that you have out there, and see what you think, whom you think going forward can outperform, not just over the last 2 years, 3 years, as we've shared. That not necessarily a good indicator of what lies in future. View on power and energy sector. I think also metal sector. I think we won't. I'll skip this question for next time when we would have team members cover metal sector. Yeah, we'll try and remember that. But in the interest of time, we'll keep moving. What prompted Infosys exit at its lowest point? Since then, it's gone up. So again, I would not repeat what I said. 61% of the time, the team has made the right decisions. There have been 39% of the time decisions have been wrong, and it's too early over the last just 1 month to judge them on a decision. And we would make wrong decisions. We have made a lot of wrong decisions. We would make wrong decisions. If you can find a manager anywhere in the world or a team, investment team, who has not made wrong decisions, please let us know. We will shut down shop and give all our money to them. Please share your outlook on the banking sector. Despite low valuations and positive foreign sentiments, index is not performing. Parag, do you want to address this one on banking sector?
There are, if you look at, firstly, the banking stocks have done very well if you look at last 3-4 years. If you look at last 1 year, there has been some underperformance, mainly because of the 2-3 reasons. One, as I highlighted in Paytm questions, right? Regulator has been quite strict on a lot of things like deposit mobilization, correcting the balance sheet. Secondly, there are rate cuts talks which are going on. Indian banking actually lends floating and borrow fixed, so there could be some near-term impact on margins. So all those, very short-term, very short-term trends or implications for the banking sector have led to some bit of underperformance. But I think the long-term story is quite promising, as we highlighted in the earlier question as well.
Almost every given year, a different sector is the best performing sector and a different sector is the worst performing sector. 2017, IT services was, I believe, the worst performing sector. 2018, 19, 20, then it was the best performing. 22, it was the worst. So that keeps changing. I think we don't try to time what sector would do well this year, or we try to find the best winners in the sector. And over time, as Parag was saying, even including over the last 6 years, the team has generated solid alpha from financials, 18.5% alpha. Our portfolio return has been 149% compared to 96% of the benchmark. Yeah, so very strong alpha generation is what we look for in each sector, and the portfolio has managed to, at least in the last 6 years, deliver that. Yeah. And we continue to look for opportunities on a stock-specific basis rather than try to time the sector. Focus was more on returns since inception rather than talk about what went wrong in the last 1 year. I believe, sir, we did go through what went wrong over the last 2 years as well as since inception. So I believe the question was answered. Please share your outlook on the banking sector, which we did. Will switching into mid-cap MF bring better returns, especially consider the heavy fees and taxes in PMS structure, and since MF is more efficient vehicle for good returns vis-a-vis the pioneer PMS? Look, at a point in time like this, when small and mid-cap has done very well, backward-looking, certainly, any mid-cap fund would appear to have delivered better and would hold. Someone was asking me, someone was like, earlier, just 6 months ago, by some quirk, just pure coincidence, if you were to look at trailing 5, trailing 10, trailing 15, trailing 20, on all time periods, small caps are looking fabulous. Yeah. And obviously everyone would agree that 20 years is a pretty long time. But what happened was, put yourself back in 23, mid 23 or so. Yeah. It was August 23 when I met this client in Mumbai. Trailing 5 years meant you are comparing it from 2018, after the mid and small had taken a heavy beating. Trailing 10 years would mean you're comparing against August 2013, which was a decadal low, cycle low in mid and small cap. Trailing 15 years meant you're comparing against late 2008, which is just in the midst of the global financial crisis. And 2003 meant you are comparing it against a multi-decade low. April 2003 was a multi-decade low for the market, particularly for small and mid cap. So by a quirk, by a complete coincidence, if you look at this trailing 5, 10, 15, 20 years, you'll think small caps is the only place to be. But there is no evidence that over extended period of time, small caps have beaten large caps with any degree of consistency or to any magnitude. Yeah. So point in time often sways an individual's view or perception of these things. Having said all this, yes, a good management team, including our investment team, can extract more alpha from inefficient segments of the market like small caps and mid cap. And we have demonstrated extracted more alpha in small and mid than in large. And any good investment team, probably the same would be the case. So in mid and small, the alpha opportunity is larger than large cap or all cap strategies. That is universally true for all managers, including us. Why are performance numbers subdued for the period from December 20 to December 23? We went over this exact same question at length. Maybe the question was typed before that, so I would skip answering because it's already been answered. Then there are questions about Zomato and Campus, which already has been answered. So I see a lot of performance alpha generation on, there's a lot of positive alpha generation on mutual fund schemes of WhiteOak. I wish to understand factors generating such outperformance and whether it is sustainable or not for long term. Obviously, we believe that our mutual fund performance, the way it's being generated, is sustainable. As you saw, the team here over the last 6-7 years has delivered top-notch peer group performance. You would expect something similar from our MF counterparts also. But again, like here, it may not come like a fixed deposit every single month, every single year, every 3-year period. It can be somewhat volatile. Having said that, mutual fund is designed with greater risk control. Yeah, because the nature of the investor base is such, though I'm no longer sure that retail investors are less tolerant of underperformance, or high net worth individuals are less tolerant of underperformance. But basically, the distributor plays a big role in MF as well. So it is designed with better risk control, and hence they are more sensitive to what is in the benchmark. So it is true that mutual fund product would have less underweight in PSUs and conglomerates and utilities and energy and so on and so forth. So in a year like we had last year or two, when these segments do extremely well, you can expect our mutual fund schemes to do better than PMS schemes. Yeah. But in the prior years, if mutual fund had existed for WhiteOak, it is possible that PMS might have done better. So there'll be periods when PMS would do better. There are periods when MF schemes would do better. So then there is my questions for Prashant, but there is no question attached to it. So question for Rohit. Yeah, Rohit, can you address this here, please? Your thoughts on how you reckon your digital portfolio shall perform over the next year or two?
So the space in the market, the way we built this, right, is leaders. It's the digital leaders portfolio. So it comprises of 3 or 4 types of companies. One, companies that are directly in the quote unquote digital economy ecosystem. It could be internet companies. It could be companies that are building infrastructure for, these internet companies and the internet ecosystem in India. And then we are also looking for, companies in various sectors who are adopting, quote unquote, this digital ecosystem, whether it is new technologies, new ways of doing business, using technology, etc., to leapfrog competition in their respective sectors and gain market share, right? So digital leaders in various sectors. It could be in old economy or new economy sectors, consumers, healthcare, etc., etc. So that's how the portfolio is constructed. And this segment of the market has underperformed in the last couple of years. 22 was a very bad year for this segment of the market. Significant underperformance. There has been some recovery in the last 1 year. This is really, again, there was a question on luxury consumption, and we see that as a multi-decadal theme. This could also be seen as if not as long, a reasonably long-term theme in India, where digital adoption, in terms of enterprises adopting various digital technologies to become a better version of themselves and leapfrog, that journey has just started. And if you look at versus markets like US, etc., where this adoption was slightly earlier, and look at this segment of the market, has delivered extremely solid returns in the last 10-15 years. We believe the next 10 to 15 years, you'll see a similar story in this ecosystem in India. So yeah, we've been very positive on this one for the next 10 to 15 years.
Great, thanks. We are past the time, but I do see there is most of the people are still on the call. Sunanda, we have a few more questions, and there might be people who are expecting their questions to be answered. Do you want me to continue with the rapid fire, or should we stop here?
Prashant, we can continue for another 5 minutes and then we can wind up.
Okay, great. So there's a question about fund size and alpha, which I've already answered. And as I said, the largest of the AMCs over the last 2-3 years have done far better than other ones. So at least, that not to rehash the whole thing, I'll pause there. And can you kindly share your view on infrastructure. Again, I would park this question, please, for the next time, because there's on energy sector and now infrastructure. Maybe Sunanda next time, given that it's anyways a very popular segment of the market right now, infrastructure, power, and all these, we should have those team members as well. I can cover, but just it's going to take time, so I'm going to skip. What mechanism we have? Sorry. Yeah. What mechanism we have at AMC levels to avoid companies like Polycab, Z, Paytm? Some AMCs are able to avoid completely, while other AMCs are. I'm not going to go into individual company names. We don't even know whether they're necessarily done, something dramatically bad. What I could say is I believe these names weren't in the portfolio, at least at the time that the negative news came out in the MF side. But certainly these names were not there in the PMS AIF portfolios at the time they came out. Given our focus on, in hindsight, over the last 2 years, obviously that hasn't worked for us, but over the last 6 years, as I showed, it's worked out very well for us. And not just over the last 6 years, but over my career, it has worked out very well. And our team has an extraordinary track record. We are not saying we are going to avoid every one of these disasters that might happen in future, but our past track record is extraordinary, outlier track record in terms of and that's the reason why in 2018-19 we are top of the peer group. You must all go back to the newspapers online and read what were the companies that were blowing up in 2018-19. I'm not going to name them, but none of those we had in the portfolio, and that's the reason why we're top of the peer group in 18-19. Those very same companies that blew up in 18-19 are up 50 to 100% in 22 and 23, by the way. And what helped us in 2018-19 is hurting us somewhat this year. And some of the names that are listed here that the person who's asked the question cited, I'm sure some of them would do extraordinarily well going forward.
Prashant, in the interest of time, last 2 questions. There are a lot of questions on the construct of PMS versus MF, which you would recommend. That would be my second last question.
So I think I covered that the big difference is that MF is more risk conscious, and hence they would not have so much variance in sectors like owning nothing in energy, owning nothing in utilities. I'm very sure they have companies in energy, utilities, and they have more of PSUs than what we own in PMS. That we are almost close. So a lot of this is repetition, and that we've covered opinion about BFSI and healthcare sector. We've covered BFSI, both BFSI and healthcare. It's a positive. We look at more stock specific rather than have an overall view. Both healthcare and BFSI, we've just recently launched our mutual fund schemes. We would not have launched if we had a negative view. We either have a positive view at a sectoral level, or more likely we have so many great ideas from a stock specific level that we decided to launch these funds. How do you see the spending tilt towards capex from government impacting good versus bad governance, good performance of coming years? Very interesting question. I think there's some very strong, as you've seen in the company names that we've added, like CG Power and Grindwell Norton. There are some extraordinarily well-managed companies, well-governed companies in this sector as well. It is positive for them, the capex boom. People have said that we've not answered the specific question, but I think by now we've answered that specific question. Then there is question on Fed bonds, debt refinance with so much bonds rematuring by the Fed. This is a US linked question about so much refinancing to be done in the US. Look, 1995, I went to the US to study. Yeah. I remember in a classroom in 1996, the same question was posed to a professor. It's 27 years and running. That problem of refinancing US debt has not occurred. Maybe it would come someday, but I am not betting, nor does the team bet on those things when investing in the portfolio. These are things well above any of our pay grade, including everyone here today on the call. And we should remain focused on making money in the Indian market and these things would not have an impact, in my view, on the Indian market. How do you see markets and PMS with regards to how Indian markets will perform? As general perception is the government is going to return back. Everyone's counting on the government to return back. If the government returns back, that's well and good. We should see about double-digit returns in the market would be base case expectation. If the government doesn't come, there'll be a sharp pullback that we should have no doubt about. What factors are likely to help bring high governance firms to the top performance bracket? Or do we believe that low governance firms are likely to thrive over the next year or two? It's impossible to say, sir. If anyone knew, then obviously they can make a tremendous amount of returns. But these are things that impossible to predict. Not difficult to predict, it's impossible to predict. So you have to have a well-balanced portfolio, but on top, we have a big governance tilt because that allows us to generate higher alpha over time because alpha potential is higher in better governed companies. Can you please share your views on defense sector? Again, I'll club it for later next time, so you all will join next time as well, as we would, be covering a lot of those sectoral specific questions. Within 1-2 quarters, we get to know your stock is falling, your exits are pathetic. Again, I don't know what the person is trying to say. The proof of the pudding is in the numbers, not on your specific observations, sir. PMS vis-a-vis MF as a format of investment. I've already gone through that. As you compared with peers and told they are following specific factors here, but from other side of the table, you are following a factor of good governance. No, I didn't mean to say they are following factor strategy. I'm not suggesting, please to be clear, that these peer groups are following a factor strategy. Every one of these 12, I believe, are stock selection in the peer group, but everyone whose stock selection has some style factors as a byproduct. And that is the point, not that is the intended strategy. Even those who have poor governance, that's not their intended strategy to go and buy poor governance stocks. But their stock selection approach is such that leads at an aggregate level to possibly more poorly governed names. So I hope I'm clear at that. PMS vis-a-vis MF. So there are quite a few questions on that, but hopefully we've answered. So someone has thanked me. I assume their question has been answered. What is meant by poor governance? Do you think corporate governance itself has improved? It's an evolutionary process. I learned most of my governance lessons in US at the turn of the century, covering telecom and media. So even there, they manifest themselves time and again in different forms. Yeah. But in the basic human instinct to cheat and swindle is present across the world in similar measure and has been present since the start of civilization. It probably would persist for at least our lifetime. So I don't think that there is a revolutionary change to be expected in corporate governance. The ways it manifests itself does evolve, and gradually over time, with better laws and regulations and transparency, yes, there is gradual improvement. I think we're pretty much covered at least most. There are some thank yous. People have appreciated that we've answered all the questions. There's several one of them. So I think we can stop here.
Sure, Prashant.
As more or less we've covered everything. And apologies, some of the questions are still coming at last 1 minute. But I'll take this last one, which is the last question that has come in. If we start PMS currently period, then what time horizon should we look at? Again, I would say with any manager that you invest with, please think of at least one market cycle. I know a lot of people think 1 year is long term, 3 years is long term. It depends on what are the factors. If you're investing with a day trader, maybe a day is long enough or a few days is long enough. Yeah, because their style is that of day trading. If you're investing with most of the PMSs who are stock selection based, you measure over market cycle, particularly factor cycles pertaining to the factor risks that are present in the portfolios. In our portfolio, the two key factor risks are size and governance. So any time period that covers both these cycles, size cycle and governance cycle, is what you should measure us against. and that should be the time horizon. Historically, the cycles have been 7-8 years in the market. 92 peak, 2000 peak, 2008 peak, 2008 peak, 2017 peak in small and mid caps. And now we don't know when it would appear next, but 7-8 years tends to be historical time of the cycle. I'll stop there. Thank you all of you brave souls who are still on the call. Thank you so much. I think this rapid fire Q&A, please give us your feedback if you found it useful. And I hope I've covered almost every single one of the questions except for the defense and power and infrastructure sectors which we would address with the concerned expert on the team on the next call, and hope you'll all join us again next time. Thank you all. Sunanda, back.
Thank you, Prashant. And thank you, Rohit and Parag, for all your detailed explanations. Thank you to all the investors for taking out time. We thank you for trusting WhiteOak with your money, and we look forward to seeing you next quarter. Thank you again.
Thank you.